Unfortunately, the chance of a recession has just skyrocketed in the last 48 hours. And while we cannot control what happens in the global economy, we can control our response to what happens. And frankly, this is what a financial advisor does that really adds value to their clients is help them think about how do they react towards that. So that's the spirit of this video. Let's jump in. The first thing I want to do is share with you. This is from the Wall Street Journal, and the article is called JP Morgan Raises Recession Risk to 60%. That's a really high likelihood. It was 40% before the Trump tariffs were announced about 48 hours ago as I record this. The article says that a global recession is more likely to happen than not this year, thanks to Wednesday's tariff broadside from the United States. That's the opinion of JP Morgan analysts who raised their forecast to 60% on Thursday. That's up from 40% before President Trump's Wednesday afternoon announcements that sent the markets tumbling. As I record this, the market, the S&P 500, is down 8 or 9% in the last two trading sessions. Today's trading session is still going on. This is from CNBC. You can see what the markets look like as I record this. This is after the 4% drop, 4 to 5% drop the day before. So the Dow Jones is down over 4.5%. The S&P 500 is down over 5%. The Nasdaq's down over 5%. And the Russell 2000 is down over 4%. Okay, so what do we do? How do we respond? What's the best course of action? So first, I want to share an excellent article with you from Morningstar. And then, having been a financial advisor myself for over 20 years, I'm going to share with you my thoughts. Okay, let's jump into this Morningstar report. And the article is called What We've Learned from 150 Years of Stock Market Crashes. And it says, though they varied in length and severity, the market always recovered and went on to new highs. And that's an important thing to remember as we're going through this. This shows a chart from 1870 to, a couple weeks to 2023. And what I want to point out is that the market goes from the lower left to the upper right over time. Unfortunately, there's some really scary periods in here where the market goes down and stays down for a period of time. You can see some of this. This is World War I in influenza. Then we've got World War II, the Great Depression in World War II. And some of these periods are pretty long, right? This is 1929 really until 1950. Now we have another lost decade we're going to see up here, but there's lots of scary periods here. Inflation, Vietnam and Watergate, Black Monday. This is the lost decade, which would include the dot-com bubble bust. That's what this is. Then it goes back up, and then we had the great financial crisis. Then it goes up again. And look at COVID, man, in hindsight, that looks like almost just a non-event, right? But by far, the majority of the time, the market is going up and to the right. Okay, so that's some data. I'm going to get into what Morningstar says, but the most important thing here is to make sure that our asset allocation is correct. I've done a lot of videos on this in the past. Your asset allocation is what percent of your portfolios in stocks, what percent's in bonds, and the right answer that a financial advisor should give you if you're working with one and you ask them, what are you doing to protect me? What should we do? The answer that a financial advisor should give you, a good one, is what we're doing to protect you today is something that we put in place 3 years ago, 5 years ago, 10 years ago. And it's getting that asset allocation correct. So that's the first thing that I want to lay out is, unfortunately, volatility, the movements, ups and downs, scary corrections like we're seeing today, unfortunately, those are a feature of the stock market. They're not a bug. And the best thing to do is what you have done in the past. But let's see what we should do today. let's go back to that Morningstar article. They talk about some of these events in the past: the Great Depression, the lost decade, inflation, the Vietnam, Watergate. And then they go on to say these examples demonstrate the frequency of market crashes. Though these events are significant at the moment, they are indeed regular occurring events that happen approximately once a decade. And if you just look at our last 20 years, right, we had 1999, we had the dot-com bubble bust. Then we had 2007, 8, 9, we had the great financial crisis. And then in 2020, we had COVID. So about every decade, we seem to have something that takes place. Now, we had COVID. Now, the good thing about COVID is the time to recover, that period of time to recovery, not only was it the steepest drop in the stock market history, the S&P 500 was down about 30% in 4 weeks. That was the most rapid drop ever, but it was also one of the most rapid recoveries ever. And so the period of time until we got back to previous highs was 3, 4, at most 5 months. I think it was closer to 3 months. And unfortunately, that's not normally the case. Normally, it takes longer than 3 or 4 months. And normally, we're feeling the pain for a period of time, and that's one thing to set our expectations on, is to know that we're likely going to feel the pain unfortunately for a period of time. So lessons learned about navigating stock market volatility, back to the Morningstar report. What does history tell us about navigating volatile markets? Mainly that they're worth navigating. I think that's one of the key points. And then they go on to say, but since the path to recovery is uncertain, the best way to be prepared is owning a well-diversified portfolio that fits your time horizon and risk tolerance. Investors who stayed invested in the market in the long run will reap rewards to make the turmoil worthwhile. Now, I'm sure somewhere in this article it also said that past performance is not indicative of what's going to happen in the future. Just because that happened in the past, there is no guarantee that it's going to happen again. But if you believe in an America, if you believe in a world that's going to continue to strive to do things better, faster, and cheaper, then we will get over this. Eventually, we will get through this tariff war. Things might get worse before they get better. None of us know. As I record this, it's less than 48 hours since the Trump tariffs were announced. But the most important thing is for you to stay calm and to not make rash, fearful decisions that you may end up regretting later. Now, I don't know. I know that I don't know what's going to happen to the stock market. And anyone that tells you that they do, I'd be really, really cautious, because the reality is those crystal balls are in very short supply, and most of them are cracked when they issue them out. So stay the course, continue to watch my channel. I'll continue to share with you my views on what we can do. But the number one thing is what you did several years ago, several months ago, to make sure your asset allocation was right. And now it's really about staying calm and trying not to over-focus on what's happening in the stock market. It's about making good decisions. If you like my videos, if you want to learn more about making good decisions in difficult times, the YouTube algorithm says this is the next video of mine that you should watch next. Thanks for watching this one. Bye-bye.